All right. So we're on the next lesson. We're going to be talking about management, how to manage your trades, your open positions. Now, this is extremely important. Extremely. I remember, tell a little story. I remember I was once at a barber shop a few years ago, a while back, during the time when cannabis stocks were in a massive bull cycle. Okay, there was some cannabis regulations going on in Canada and US, and the cannabis stocks were popping. All right. And my barber, who doesn't know anything really about trading, um, this is like we're talking like downtown finance district, proper barbershop, right? My barber, who was kind of all in a few cannabis stocks, doing really, really well. And he was all talking all about it, bragging all about it as I was getting my haircut. And then, the next time I went in, which was like 2 weeks later, um, it was all gone. And he was running at a negative, at a loss, you know? And I was like, what happened? And he's like, well, nothing. They just fell. They stopped going up. So I'm like, well, why don't you do anything? He's like, well, they're still going to go up. And to this moment, they still never did. It's been like 5 years, you know? So management is extremely important. It's not just about finding ideas, right? Finding ideas, sure, it's extremely important. You need to have ideas. You need to have a lot of ideas, and they need to be good. So you need to have a lot of good ideas. And then obviously you need to enter those ideas. If you don't execute on those ideas, what's the point of having ideas? Right? So you gotta execute on them. You gotta take action. You gotta get into those trades, right? But then once you're in those trades and they're running well, and then you don't lock in profit, what's the point of generating idea and getting into that trade if it plays out in your favor and you don't do anything about it? Just let it disappear. Now most people don't have a process. Most people who are not educated traders or investors, they don't have a process. So they're just like, oh, here, cannabis regulations are going on. I'm going to buy this stock and see what happens. They don't do much research and so on. They don't really enter at value, right? It's the whole process is flawed. So in this lesson, we're going to be talking about management because we already covered everything else, right? So I got a quote there. Well, we covered the idea generation and execution. So now it's time for management. So now we should be in those trades, right? So managing a trade well is often more important than the entry point. And it's true. It is true. Yeah, it is very true. Entry point is extremely important, like extremely important. But then again, if your entry point is really good, but then you fuck up your management, what's the point? And again, I see this all the time, because I've been working with a lot of traders over the years. And I do see it all the time where, you know, they are in good trades and trades are looking good, but then they let the profit disappear, and then the trade is zero, nothing. Or they enter a good setup, but then forget to remove risk or don't remove risk, and that loss could have been avoided, could have been zero or partial, but it was a full loss, you know. Or they get into a good trade and that trade is kind of not doing anything and they break their rules and kind of do a discretionary exit, and then it pops and is a massive win, hits their target. These are all kind of behaviors of not following or not having rules, right? The thing with management is that when you have a management plan, a set of rules, you don't do any thinking anymore. This is kind of like something that I talk about quite often with my elite enigma traders, is that once you decide on a plan and a set of rules for each part of the system, idea generation, execution, management, Once you make this into a system and you implement rules, things that you act on, if this happens, I do this. If this happens, I do that, you know, rules, protocols, right? Then most of the thinking has already been done. Most of the thinking is building the plan, is building a set of rules, right? That's the thinking. And then once you're in the trade, the execution system, there's not even any thinking there because it's once you've already thought about it and wrote it on paper and you're like, this is my plan, enter on a trend change in the value area, you know. If you write that down and you're like, that's a plan, well, there's no more thinking there. It pulls back to value, gives you a trend change, you're in, right? It's the same thing with management. People get their emotions get going and then they don't do steps or they remove targets or they do discretionary exits and a bunch of weird shit, you know, because it's emotions. People get they have either fear or greed. It's either or. It's either you're acting based off of fear, you don't want to lose money, you don't want to see something disappear, whatever, right? Um, or you're acting from a place of greed. You're like, this shit's gonna fucking fly, so I'm just gonna remove my target. I'm not gonna do any profit management, and then that shit goes to zero. You know, it's a very funny concept, but it's like as soon as you remove the emotions out of it and you just act on rules that you've already thought about and set in place, it becomes much simpler and it becomes very straightforward, you know, and it's very black and white. So the intro here is how you manage trades after entering them can significantly impact profitability. This lesson covers advanced techniques for open trade management. So we have two terms here: initial profit target and main profit target. Okay, initial profit target and main profit target. So I'm gonna go and screen share first. And I want to show you some. So let me just make sure I'm sharing the right thing. Yep. Okay, so I'm in trading view here and I'm just going to draw a couple things. So, you know, just imagine a bearish trend. Price action is trending. This is price action. So price action is trending. And, you know, hold on, let me do a full bearish trend. So price action is trending. And then it starts to decelerate. And then it gives a breakout, okay, a trend change, right? Let's assume this is like a 1 hour time frame for a day trade, or it doesn't really matter. Let's just assume this is on the bottom left chart, which is the run that we're trying to capture, right? So let's say this is a 1 hour chart on a daily layout, you know, so on a daily day trading layout, 1 hour chart breaks out, and then it's pulling back to value, right? So as it breaks out here, we're already, this is when we're flagging this and putting this on our watch list, right? There's going to be an EMA here, which is going to be like, imagine this line right here is a red 50 EMA, you know, and imagine roughly the same thing. You have a line right there, which is purple 200 EMA. Okay. So imagine we have a 200 EMA, imagine we have a 50 EMA, all kind of lining up in this area. Let me make this brighter because I can see that's a little bit harder to see. There we go. Okay, right, so we got a strategy here that's called a CBO. And we're going to position size this, right? So we want to position size this so that it's 1-to-1 to the tops or better. Stop around 0.618 or better, you know, so we can Play around with this a little bit. We can go something like this, and this feels pretty good. So let's do... Oops. Here's what our base position looks like. And we're going to draw our Fibonacci extension, right? And we're going to try to get a 1-to-1 to the highs and 2-to-1 up to 0.618 Fibonacci extension, right? So this is our base position. Now, I want to explain... sorry, I want to explain initial profit target and main profit target, all right? So we got our position and it's planned out and execution. Now we're just waiting to enter this trade, right? So we're waiting for price action to retrace, to pull back. That's what we're waiting for. So once price action goes into a pullback, obviously now we're going to be getting into this trade, all right? So what's the initial profit target? The initial profit target is 1R, right? So it's where our 1R profit target is. So in this case, it's 47,970 right there. So we're going to put a line, and I have a line here created, which is target. It's just this green dotted line, you know, and 47,970. This is exactly where 1R profit target is. So this is the initial profit target, okay? Main profit target is main profit target. It's up there. We always need to have a main profit target. This cannot be nothing, all right? We always need to have a main profit target. So this is kind of what a base position looks like. Base position sizing for the base trading system that I'm teaching in this program here. So now that we've, you know, got our idea and the idea pulled back and the triggered alert and we got our position size and it's all good and now we're just waiting to enter this trade, we identify where our 1R is, our initial profit target, and we identify where our main target is, which is the main target, right? This area between 1R and 2R, this area between 1R and 2R is our target area, or we also say our profit area. This is our profit area. Okay, this is where we take profit, our profit area. Target 1, target 2. Initial target, main target, and in between, profit area. Okay? Now the goal is that this 1R, this initial target, is always kind of below the high, right? We want to make sure, here's the main concept. We want to make sure that when we're position sizing our position in the execution phase, we're position sizing in a way that when we're entering this trade, there's a lot of shit between our entry and stop loss, meaning price action. In order to hit our stop loss, we need to break the 200 EMA, the 50 EMA. There might be a horizontal level there, Fibonacci retracement. So it needs to break all this stuff in order for a stop loss to be hit. Right, so from a position sizing execution perspective, we always need to make sure that our stop is protected. All right, but we also need to make sure that from our entry point, there's nothing in the way towards our initial target. There almost always is going to be something in the way towards the main profit target, but nothing towards the initial profit target. So what I mean by that, initial target cannot be up there, because now we need to trade through this high in order for initial target to be hit. We want to make sure that this initial target is extremely, extremely easy to hit. So we always want to have it before the extreme high or before any support and resistance area. Right? So the initial target needs to be easy to hit. And ideally, same thing with 2R. You know, ideally the same thing with 2R being before the next main support and resistance area. All right. So that's kind of it for now. So I explained here the initial profit target and the main profit target. right? So initial profit target is always nice and easy to hit, and the main profit target is the main profit target, right? And we're doing base plan 2-to-1 position sizing, right? So now that we know that, we have a few rules, and I call them P1, P2, P3, P4. In other words, phase 1, phase 2, phase 3, phase 4. And the last one is FS, stands for fail safe. Fail safe. Okay. So I got 5 rules here for management. P1, P2. So these first rules, P1 and P2, they're for removing risk. Okay. P1, P2 is removing risk. So we always have risk on the table. P1 and P2, they're about removing that risk. P3 and P4, they're about locking in the profit. Okay, so once we remove risk, it's time to lock in profit. And fail safe is a discretionary rule to a degree, where our main target is missed or where our initial target is missed, we can do an exit. So I want to talk about P1, P2, P3, P4, and fail safe. And I'm going to do that by going through examples. All right, so let's get back on screen share. And I have a bunch of examples, but yeah, I have a bunch of examples. So from let's go through these examples here. When it comes to our layout, this is a day trade. So this is a day trading layout on a daily chart. So I got the daily, top left. Every single example I'm going to show you is going to be a daily day trade. Daily on the top left, daily 4 hour, 1 hour. Okay, 1 hour on the bottom. That's the main run that we're trying to capture. Okay, direction prediction on the top to capture this run on the bottom. And then so these are our analysis timeframes. Our left-hand side are the analysis timeframes, right? On the right-hand side is execution, and we already covered that. Entering on a trend change, right? And but it's also management, right? So when it comes to managing the position, we're following this trend, okay? The trend that develops on the right-hand side, we're following that, and it's the same concept. Exit on a trend change. So I'm going to even put that rule here. Exit on, I do have that rule. It's right there. Exit on a trend change in the profit area. Okay. So it's management is relatively the same thing, that when we're entering the position, or the whole thing really is like when we're finding opportunities, we're looking for new trends to develop, runs that end on the left-hand side, runs that finish and new runs beginning, therefore new trends beginning. So we're always kind of looking for that. And the same thing for our entry. We're looking for the trend change, right? So this entry came in right there on a trend change, on the breakdown, top right side, right? So enter on a trend change. Now the same thing, exit on a trend change, right? But let's talk about P1. So I want to talk about rule 1, P1. P1 stands for P1 stands for remove partial risk on long-term management trend change. Remove partial risk on a long-term management trend change. So what is long-term management? Okay. Long-term management is the top right chart. So if we go back to our chart, long-term management is the top right. Okay. So we got regular management is in the middle. Regular is in the middle. This is kind of like standard, regular. Aggressive, bottom. Long-term, top. Okay. It's the same for execution. Aggressive execution is at the bottom, regular or standard in the middle, and kind of like long-term or conservative from an execution perspective, we call that conservative on the top, right? Now for management, it's the same thing, aggressive on the bottom, regular in the middle, and long-term or conservative on top. Okay, for management, we call it long-term management. Okay, long-term, short-term, aggressive. So management P1 happens on remove partial risk. So let's select P1 there again. Remove partial risk on long-term management trend change. Okay. So you see how this trade was entered. Forget about the entry for a second, but this trade was entered, right? And on the top right, when this long-term trend breaks, okay, this entry already happened on the long-term trend break, roughly, but it's mainly when these lows fully break, which was like right there and right here. This is when P1 happens, right? So when price action is already falling, you can kind of see it on this position here, on the bottom right. When price action is already kind of falling, but the main trigger is the top. Once the trend breaks on the top, so it was bullish, the trend broke bearish. Once that happens, then we can do P1 and remove partial risk. And what does that mean? Removing partial risk means we're clipping these highs. Okay, so on our example here, I'm going to show you a bunch of examples, but on this example, what does that mean? So we entered this trade, right? Like right here. We entered this position and price action is running. Okay, well, eventually this run is going to go farther. And it's typically around this point when this run has begun. So this run on a 1 hour chart, when this run on a 1 hour chart begins and we're in this trade and this trade is running in profit, the long-term management trend will change. A run on a higher time frame as a trend on a lower time frame. So if a new run begins on a higher time frame, in this case the 1 hour chart, a new trend will develop, right? And that takes us to our time frame here. Once this run begins on a 1 hour chart, bottom left, right? Once this run begins, eventually the trend will begin, right? So once this trend begins, that's when we remove risk. And we remove risk by clipping these highs. So we take our stop loss from full -1R to clipping the highs. And that typically removes about half risk. So I call it P1. It's kind of like partial risk removal. You know, P1 removing half risk there. So I'm going to explain every single phase and I'm going to go through a bunch of screenshots, right? So that's P1, removing partial risk, clipping the highs. In our example is, that would be, I have another, and I recommend creating another line template, okay, for a line, horizontal line. This is my stop loss. So P1 is when this run is happening and it's already in the move, P1 is clipping this low, clipping the low, and removing partial risk. Sometimes almost all of it, typically about 50% of risk is removed, right? So that's P1. P2 is, and I'm going to show many more examples, but P2 is remove full risk on long-term management trend confirmation. Okay, so remove full risk on long-term trend confirmation. Okay, so going back to our example, P2 was done this right here, you know, so you can see this another line, that's P2 right here in the middle, top right middle time frame. P2 is right here on the bottom, P2 is right here on the top. So you see how this it has already been trending, and mainly on this 2 minute, this has already been trending down and it's trending in profit, right? And on the top chart, it has already pushed so far. It's already definitely trend has confirmed, new trend has developed, you know, because P1 happens on the initial trend change, which is like right here in this area. You know, once it started to break down, went from bullish to bearish. It's kind of where P1 happens in this area, right? Now, P2 happens once this trend is confirmed. So it's typically when it falls a little bit farther. Now, this is like, yeah, it's definitely bearish. And that's when you remove full risk. So P2 typically happens when, you know, price action breaks down, you do P1. And a lot of times it pulls back a little bit, forms a lower high, and continues farther, makes a new low. So when it makes a new low, you clip the high, remove full risk. So that's P2. This is how we manage our risk. By following these two rules, okay, this is important. By following these two rules, P1 and P2, we're gonna, by always doing that, we're gonna take our average loss from being -1 to about minus 0.5. Because sometimes we're gonna have full -1 losses, sometimes we're gonna have zeros because of P2, and sometimes we're gonna have partials because of P1. On average, over 100 trades or whatever, we want to make sure that our average loss is about zero point 0.5 because of those rules, right? That's what I mean. It's very mechanical. As long as you follow these rules, it's always the same step, right? So that was P1 and P2. And let's go to our example here, right? So P2 would happen. This is now flying. Once it's already moving that far, you just remove risk. And on that lower time frame, there is going to be a trend because this is already running quite a bit. There is a trend already. Trend has confirmed. So by this point, when this is almost at the initial profit target, you definitely don't want to have any risk on the table. You should not have full risk. You shouldn't even have partial risk. When this is at initial profit target, you should definitely be risk removed. You know what I mean? Extremely, extremely important. Yeah. So let's go to our next set of rules. When in the profit area, secure initial profit target. P3, P4. When in the profit area, secure initial profit target. And P4, on a exit on a trend change in the profit area. Okay. So let me explain these two rules. So once we are in the profit area, okay. So once price goes into the profit area, so it just broke 1R. Our job all of a sudden switches from removing risk to now making sure we don't let this shit disappear and go to nothing. Okay, so this is now where we utilize the three other rules: P3, P4, and fail safe, right? Now, as soon as we do P1 and P2, as this goes into the profit area, all of a sudden P3 kicks in, okay? Which the whole goal of P3 is locking in the initial target, right? So this typically happens when price action is running a little bit higher, right? Our goal is, well, we're not taking less than 1. So we're getting the fuck out of this trade around 1R, So how does that look like in action? Let me take you to this screenshot, right? So again, the same example that I've been showing earlier, right? So this trade now is running, so it's running, and right here you can see it crossed the green dotted line, so it went into profit area, right? And all of a sudden there's a line here. This is where I did P3, okay, right there. So on this time frame, we don't need to look at the 15-minute anymore. It's just wherever is the trend, okay? So pretty much middle time frame here, as price action went into profit area on the middle time frame, price action then pulled back a little bit, right, and fell. Once it made this new low, I did P3 and I locked in the 1R, clipping this high. It's always nicer to clip something if possible, right? Now P3 could have been done a little bit more aggressively. It could have been done right here as the 2-minute, this aggressive time frame went into profit right here. It formed the lower high. I could have done P3 and clipped that. Yeah. So that's P3. P3 is once it goes into profit area, you're looking at the management time frames and you're trying to determine, okay, what can I clip so that I can safely, not choke it, but safely lock in 1R. It's always something to clip, ideally, So that's P3. And I'll show you more examples. I just want to go through these main lessons. And P4, the rule for P4 is exit on a trend change in the profit area, right? Whereas P3 is like lock in the initial profit, right? P3 is lock in the initial profit. P4 is exit on a trend change in the profit area. So now we're like in the profit area and we're trending. So now we're trying to identify where is the trend. And it's definitely here on a aggressive time frame, on the aggressive management. Price action is obviously trending here. So we did P3 as this broke down, clip the high, lock in the 1R, and I kept on trending. And right here, I did P4, which I clipped this high right there, still clipping trend if possible. And I locked in roughly 1.5R. And then, if my profit target was lower, eventually I would have clipped this high, right, with P4. But then target was hit. So those are the rules: P1, P2, P3, P4. P1 is removing partial risk once long-term management breaks down. Okay. P2 is removing full risk once long-term management gives us that confirmation. And that's typically when we're clipping something. We're clipping something on P1. We're on P1, we're already clipping the main highs. And then on P2, we're trying to clip something else to lock in the 1R. Or to lock in 0, break even. That's P2. And P3, once in the profit area, we're trying to lock in the 1R. So we can either clip this high for 1R right there, or a little bit later, again, clip the same high. Right, and P4 is exit on a trend change in the profit area. So we can either clip the highs, or once this just breaks out, makes a new high, we're exiting on a trend change. So if the profit target was missed here and it just kind of double bottomed and it broke this high, we're exiting on a trend change to lock in the profit. Those are the main 4 management rules. Let me go through a few other examples here. So here's another example. This is a CBO. The previous strategy was an ACB. This is an ACB, Advanced Continuation Breakout. The rules are the same for every strategy. So this is a CBO. It's all right. It's an okay CBO, but management is interesting. So price action pulled back to value, right? Pulled back to value. I entered the trend on trend change in the value area. I was able to get my position sizing still a little bit tighter stop loss, but it all fits. 1R is good before the low, and specifically before. So initial profit is before the support, right, which is good. And 2R is at the next support area, which in this case is S1, right? So good position sizing, good entry. So entry was on a trend change right there. And now we're waiting for P1, right? So you see, we're waiting for this long-term trend change, right? So as I entered, the trend was still bullish, right? My entry came in right there. The trend was still bullish, but eventually it broke down. So as it broke down right there, that's a sign to do P1, which in this case is clip the high, right there. But I went straight to P2. Why did I do that? Well, sometimes you can skip P1, right? So in this case, that is like right there. This is on that 2-minute when that broke down, okay? When that long-term management time frame broke down, I went straight to P2, but I could have clipped a high. I ended up clipping these highs. Well, that's because, price action did not break down as soon as I entered the trade. It consolidated a little bit, so I entered the trade and then consolidated around my entry point, developing this clear lower high. So once price action broke down, there was this clear lower high, and that triggers my P2 rule. It's like I can just clip that and remove almost all risk. Why would I be clipping that? Now, this doesn't always happen, but it does happen. So sometimes you skip P1 to go straight to P2. And that's fine, and you do that because there's something to clip. And then let's cover P3 here. I never went into P4. But you see price action broke down and is now in the profit area. And it's running, so I'm just looking to clip something. There wasn't anything to clip there. I wouldn't be locking in 1R, right, this high. So I'm just waiting. Price action developed a lower high. And then I went and locked in my 1R a little bit more and then got taken out for 1.33R, right? So same goal, exit on a trend change in the profit area, but this is still like P3 versus P4. It could be P4, but it's still just kind of securing the initial profit. So this was a 2-step management versus 4 steps, P1, P2, P3, P4. This was just P2 and P3. Let me show you another example. So here we have an advanced breakout strategy, ABO, right? So we're trying to capture this breakout on the 1-hour chart. And entry was good, so entered on a trend change, in this case right there on the regular time frame, regular execution. So entered on a trend change, and then shortly later, once I'm in this position, you can see price actions falling, right? Right there, I did P1, and that is when, again, long-term trend changed. So on this time frame, trend was bullish. I entered right here. Price action didn't fully break down yet, and then once it broke down and it's running right here, that's when I did P1. And P1 in this case was clipping the highs. So let me show you right here. P1 was clipping the high and removing about half risk. Right, so that was P1. Pretty straightforward. The trigger for P1 is once you enter, price action falls and breaks that long-term trend, right? So once it breaks that long-term trend. Now, shortly after, you can see on this time frame, price action kept on falling. So I did P1, price action kept on falling, and it came pretty much to my initial target. It's almost there. And that's kind of what I said. It would be stupid for you to take a loss on this trade. You should definitely be break even. Right, so this is kind of when you do P2 because the trend is confirmed, fully confirmed. You can do it sooner, but definitely by that point, by the time price action is sitting at your 1R, you should not have any risk on the table. So I did P2 right there, and I clipped these highs just to just to remove all risk, go to break even. Okay. So now, once I do that, now I'm waiting for price to go into profit area, right? So I'm finding the dominant trend, and the dominant trend is here on this 2-minute, So price action is chopping, holding, sitting around this 1R, and then finally breaks through the 1R. Okay, so I'm just kind of waiting for something to clip or just for price action to go far enough so that I feel comfortable to just move my stop to lock in the 1R. And that's kind of what happened here. I wasn't really clipping anything. You see price action was just falling and kind of decelerating into this wedge. And I'm like, well, I'm just going to be exiting here anyway for 1R. So if this breaks out, because exit on a trend change in the profit area, it's in the profit area. So if this trend changes, like I'm out anyway. So this is kind of where you just kind of lock in your 1R. And I just did P3, moved my stop there, locked in the 1R, and then eventually trend changed and took me out. Right, so no P4 there. P4 would have happened if this kept on falling a little bit farther. Because this is still locking in initial profit. It's just right there. So it's still kind of like focused on locking in that initial profit. Cool, so we did P1, P2, and P3 in this example. Let's have a look at another example here. And we got, this is a CBO. And this got a fail-safe. Nice. So this is an example of a fail-safe. So what is a fail-safe? A fail-safe is if initial profit target is missed, do a fail-safe exit if main trend breaks. Okay. So let's go on the example here. Okay. So CBO, price action broke out, pulled back, and to the value area, and I took a trade looking to capture this move. Position sizing so that initial profit target is nicely at the highs or below the highs, like in this case, and main profit target is before the next set of resistance, which is like R1. So position sizing is good, stop is protected. I got a lot of stuff between entry and stop loss, right? So you want to have a lot of stuff between entry and stop loss, and really kind of nothing between entry and first target, and then almost nothing between entry and second target. Right, so I entered on a trend change, which was right here. Okay, aggressive entry. That's typically my go-to is the aggressive execution on the lower time frame. So I go aggressive entry right there, entry on a trend change. And now I'm waiting for this long-term trend to break, right? And eventually you can see right here, as I entered, just follow me, I'm not going to zoom in. As I entered, price action broke out, pulled back a little bit, and continued higher, right? On this time frame, again, same thing. Price action consolidated a little bit in profit, pulled back a tiny bit, and then went higher. Now, what I'm mainly waiting for is this trend right here to break. So I entered, and then boom, trend broke. So that triggers to do a management. It triggers to do P1. But you see how there was this higher low that developed? Because a lot of times I will enter and it will just break out right here. But it didn't. I entered, price action went up, pulled back, and then went up. So that kind of triggers P2, you know? Like I don't have to be going P1 right there. I can just clip this low and remove all risk. So that's what I did, you know? So instead of just doing P1 and moving my stop to below this low, I just did P2 and moved my stop right there to remove all risk. Right, I hope that makes sense. It's trend confirmation. By that time, it's not just a trend breakout, it's trend confirmation. There's a higher low and a higher high versus just a higher high, you know? So let me explain that. Trend, initial trend breakout, you do P1. So if this just kind of broke out right here, you do P1. But there was a trend confirmation, price action from the higher low, and then it broke out. Not that visible here, but it is very visible right there. It didn't just kind of move up. It went up from the higher low and high, trend confirmation. So whenever you feel comfortable in that, you can go straight to P2. So that's what I did. And as I went straight to P2, now I'm waiting for price action to move to my profit area. And it just didn't. You know, you can see for hours, this is one of those setups that just took forever. And for hours, it just kind of chopped around. It kept going up. Like it kept going up the whole time. But it didn't go to my profit target. It missed it. And now it rolled over into the next day. And I'm in this trade longer than I need to be. So fail safe is once the main trend breaks, and you can see that there's a main trend that developed here. This is the overall big trend. This is long-term management. And it's typically on the long-term management. That's the main trend overall. So once the main trend breaks, I can do a fail-safe exit. So you can either move your stop and clip a higher low here. And that's kind of what I did. I just moved my stop at this point. You know, I'm just like, this is fucking slow. There's a clear trend of it that develops. So if this trend breaks, this run is over. So what does that mean? If this long-term trend breaks to the downside, that means that this run that I'm trying to capture is over. Why? Because a trend on a lower time frame is a run on a higher time frame. And if a trend on a lower time frame is changing from bullish to bearish, right? Once that trend is changing from bullish to bearish, that means that this run is over and this run is finishing and going into a pullback, right? So I should be locking in my profit if I can, rather because it is just going to end up at zero, right? So that's the idea of a fail safe. It's like if it goes up, but it doesn't go enough, and then trend changes and the run finishes because the trend changes. You just want to get out for whatever profit you can get. So that's the idea of the fail safe. You just either manually exit, or if you see it soon enough, you can just move your stop again by clipping a higher low on this long-term trend. So that's the idea of a fail safe. Is it doesn't trigger P3 because it doesn't go into profit area. So it misses profit area and it reverses trend. And that triggers fail safe exit. So now we covered every single rule here. P1, P2, P3, P4, and finally, fail safe, right? Which we get the idea of fail safe. Fail safe, ideally you don't want to use fail safe. Ideally it goes into profit area, but that doesn't go into profit area a lot of it. Like most of the time it does, but sometimes it doesn't. Our goal is to make sure that that profit area is easy to hit. That's why we don't want to have, when it comes to that initial profit target, we want to make sure the initial profit target is easy to hit. We don't have to trade through any resistance in order to hit initial profit target. So we want to make sure that the profit area in general between initial profit and main profit is easy to hit, right? It's not just like way the fuck out there. So it all starts with position sizing and execution. We want to make sure we enter it well, have good position sizing, initial profit is good, main profit is good. And if that is done well, typically you'll be able to do P1, P2, P3, P4, right? But sometimes, even when it is done well, like in this example, price action did not go far enough to hit initial profit or to go into the profit area, you know? So that's kind of when you utilize the fail-safe exit, because if initial target is missed, exit on a main trend change, exit on the main trend break, right? So that's the idea there. I think I have a couple more examples, so let's just finish up this lesson. But that was right here. Fails, main target was missed. Main trend broke. I was out. Fail safe exit. So let me show you a couple more examples and then we'll wrap it up with this lesson. This lesson is important, but let's wrap it up. So CBO here on the left-hand side is our CBO strategy. And I entered regular time frame right there as I was breaking trend, right? So I entered, and shortly after, pretty much, it broke. So I entered right there, and shortly after, it broke on the long-term management, right? So I did P1, which was like minutes after I entered. It continued, and right there, I did P1, clipping the high, removing half risk. And then you can see right here, it pulled back, and then it followed through, forming a lower high. Sometimes it can double bottom. It doesn't necessarily need to follow through and make a new low, but it did this make a new low right there. You know, this is actually a brand new low. So ideally, we have a brand new low. And once this brand new low happens, well, now we can do P2 because it's trend confirmation. We got a trend breakdown, then a pull back from a lower high, and then from the lower low. So we have trend confirmation. And at this point, we can do P2 and clip the high, right? So that's right there, or right here, which is the same, or, you know, right there. And typically the idea with P2 is that we're protected by every single management EMA. We're protected by the long-term management EMA, the regular management EMA, and aggressive management EMA. So with P2, we still want to have stop protected, but it's just now protected by the management EMAs. So that was P2, and then you can see price action went very close to my profit area. I didn't do any fail-safe here. I could have. There was a trend right here that eventually kind of broke, and maybe I could have exited for a little bit. But this trade just ended up going to break even. Yeah, because the main trend, like when the main trend broke, like that was break even. You know, so I could have like utilized aggressive trend change, but that wasn't the main trend. The main trend, like it was kind of the main trend, so I could kind of exit right there for 0.4 or 0.3. I think that is fine. I was just kind of looking at it as the main trend right here, you know, so it's like I could have exited right there for 0.3, but I'm just going to let the shit play out, and I just took a 0, which is fine. Fail safe is like, again, I don't want you to be doing fail safe exits all the time. Another example here. So this is a CBO strategy again, trying to capture this 1 hour run. So price action pull back to profit to value area. And then I went short on regular trend change right here. Very nice entry. Right, so that was my execution. Eventually, once main trend broke, or the long-term management trend broke right here, I did P1 and I clipped the highs, removing partial risk. Right? And then eventually it continued right here. And I did P2, clipping this high, removing all risk. So let me show you on these time frames, right? Price action went into profit. I did P1, clipping the highs, and eventually pulled back a little bit and followed through. And I did P2, clipping the high, removing all risk, right? And same thing on this time frame. Just squeeze, right? P1 right there. Price action kept on trending, broke, made a new low, remove all risk. Right, and now I'm waiting for price action to go into profit area. So green dotted line. So I'm just waiting. Nothing's happening. It's just chop. And the price action ended up falling. Still not in profit area. Boom, hit profit area and it's falling. Right, so now it's running in the profit area. So, and as it's running in the profit area, now I went aggressive. And I'm like, okay, right here I did P3, locking in my 1 hour, my initial profit. Right, and then price action pulled back, and right, so now I locked in my 1 hour. Price action pulled back on the regular time frame there, kept on falling, made a new low right here, and I did P4, locking it a little bit more profit. I believe I clipped this high right there, so locking it a little bit more, and then price action kind of double bottomed right here, you know. And again, I'm doing P4, clipping this high, and exit on a trend change. with P4. So in this case, I did P4 twice. Clip one high, clip the second high, and then out of the trade. Exit on a trend change in the profit area. And final example, IBO strategy, a very nice IBO strategy. Price action breaks out, pulls back to value area. I go long, good position sizing. All right. And entry was aggressive entry on the trend breakout. Once long-term trend broke, top right chart, once long-term trend broke, made a new high, I did P1, which in this case, it was price action kept on running. I did P1, clipping the lows, removing partial risk. Quite a bit of risk actually removed, and then price action pulled back a little bit from the higher low, followed through, and I did P2, clipping this low, removing all risk. And then once that is done, I'm waiting for profit area to be hit, and eventually price action push into profit area, right? And right in this moment, I did P3, clipping this higher low, locking in 1R, right? And then it didn't push any further, so I couldn't do P4 or anything like that. It reversed, trend changed, and I was out because of P3 for 1R. And that is it. That is it for management. So a little bit longer lesson than I thought, but management is extremely important. There are many rules to go through, P1, P2, P3, P4, and fail-safe, but this kind of covers it all. Now, action is obviously make your own rules. It's probably going to be the same rules as mine. You can change them around a little bit, but it's probably going to be the same rules as mine. Keep them simple. Keep them one little short sentence. Make sure you have rules for management, for removing risk and locking in profit, and make sure you always follow your rules. Okay, you can change your rules if you want later, and as you change your rules, you change your numbers a little bit, such as P1, P2. If you follow P1, P2 rule every single time, you're going to have an average loss of 0.5. Same thing if you do P3, P4 every single time, you're going to have an average win of 1.5. Sometimes you're going to take ones. Sometimes your main target is going to be hit for twos. And a lot of times you're going to exit P4 in the profit area for 1.2, 1.3, 1.4, 1.6, 1.7. And therefore, on average, after 100 trades, if you do P3, P4 the same every single time, your average win will be 1.5. And those are really good numbers. Average loss of 0.5, average win of 1.5. That's an average reward to risk ratio of 3R. It is really, really good. Okay. But you need to follow those rules. If you break those rules, if you're discretionary with those rules, your numbers will change and fluctuate. But that is it for this lesson. I'll see you in the next one, which is journaling. That's it. Bye-bye.